When it comes to building wealth and protecting your financial future, one of the biggest and most costly mistakes people make is misunderstanding the relationship between whole life insurance, term life insurance, and investing. Many individuals unknowingly overpay for insurance, underinvest, or choose financial products that don't align with their goals. This confusion can cost thousands or even hundreds of thousands of dollars over a lifetime. We'll break down the truth behind whole life versus term life versus investing, expose the most common mistakes, and help you understand how to make smarter financial decisions. Today, we will talk about the number one money mistake: whole life versus term versus investing. So, before we start, make sure to hit the like button and subscribe to my channel. Let's start with the basics. Term life insurance is the simplest form of life insurance. It provides coverage for a specific period, typically 10, 20, or 30 years. If you pass away during that time, your beneficiaries receive a death benefit. If you outlive the term, the policy expires, and there is no payout. The key advantage of term life insurance is affordability. It allows you to get a large amount of coverage at a relatively low cost. This makes term life insurance ideal for people who need temporary protection, such as young families, homeowners with mortgages, or individuals with dependents. The purpose of term life is straightforward: protect your loved ones financially in case something unexpected happens. It is not designed to build wealth or serve as an investment. Now let's talk about whole life insurance, which is often where the biggest financial mistake begins. Whole life insurance is a type of permanent life insurance that provides lifelong coverage along with a cash value component. Part of your premium goes toward the death benefit, while the rest is allocated to a savings-like account that grows over time. At first glance, this might seem like a powerful financial tool. It combines insurance and savings into one product. However, the reality is more complex. Whole life insurance is significantly more expensive than term life insurance. A large portion of your premium goes toward fees, commissions, and administrative costs, especially in the early years. This means your cash value grows slowly at first, and it may take years before the policy becomes efficient. One of the biggest misconceptions is that whole life insurance is a great investment. While it does build cash value, the returns are typically modest, often in the range of 3% to 5% annually. Compared to historical stock market returns, this is relatively low. This is where the number one mistake often happens. People choose whole life insurance instead of investing, believing it will help them build wealth faster or more safely. Now let's look at investing, particularly in stocks and index funds. Investing in the stock market allows your money to grow over time by participating in the performance of companies. Historically, the stock market has delivered average annual returns of around 7% to 10% over long periods. This makes it one of the most powerful tools for building wealth. The key advantage of investing is compounding. When your investments generate returns, those returns can be reinvested to generate even more returns. Over time, this exponential growth can turn small, consistent contributions into significant wealth. This is why investing is often considered the backbone of long-term financial success. Now let's compare all three together. Term life insurance is for protection. Whole life insurance is for protection plus forced savings. Investing is for growth. The problem arises when people try to use whole life insurance as a substitute for investing. This is where the number one money mistake happens. Instead of buying a whole life policy, many financial experts recommend a strategy called buy term and invest the difference. This means you purchase affordable term life insurance for protection and invest the money you save into stocks, index funds, or other growth-oriented assets. This approach allows you to maximize both protection and wealth-building potential. Let's break down why this strategy is often more effective. First, term life insurance is much cheaper. The difference in cost between term and whole life can be hundreds of dollars per month. When that money is invested instead, it has the potential to grow significantly over time. Second, investing provides higher returns, which leads to greater long-term wealth accumulation. However, the strategy only works if you actually invest the difference. One of the biggest behavioral mistakes people make is spending the money they save instead of investing it. Discipline is key. Without consistency, Even the best strategy can fail. Another factor to consider is liquidity. Investing in stocks gives you access to your money when needed. Whole life insurance, on the other hand, ties up your money in a policy. While you can borrow against the cash value, it's not as straightforward as withdrawing from an investment account, and it can come with interest and limitations. Risk tolerance also plays an important role. Stocks come with market volatility, meaning their value can go up and down. This can be uncomfortable for some people. Whole life insurance offers stability and guarantees, which can be appealing to those who prefer certainty. However, this stability comes at the cost of lower returns. Taxes are another area where both investing and whole life insurance offer advantages. Investments can benefit from long-term capital gains tax rates and tax-efficient strategies. Whole life insurance offers tax-deferred growth and tax-free policy loans under certain conditions. However, these tax benefits do not typically outweigh the difference in returns. Now let's address the biggest mistake directly. The number one money mistake is overcommitting to whole life insurance while underinvesting in growth assets. Many people end up locking too much of their money into a low-return product when they could be building significantly more wealth through investing. This mistake often happens because of poor understanding, aggressive sales tactics, or the desire for all-in-one financial solutions. But in reality, combining protection and investing into a single product often leads to inefficiency. Separating the two, using term insurance for protection and investing for growth, tends to produce better results for most people. Another mistake is failing to understand opportunity cost. Every dollar spent on a high-cost insurance product is a dollar not invested elsewhere. Over decades, this can result in a massive difference in net worth. Small differences in returns compound into large gaps over time. Behavioral discipline is also a critical factor. Investing requires patience and consistency. It's not about timing the market, but about time in the market. Many people struggle with this and may benefit from structured approaches. However, relying on a more expensive insurance product just to enforce discipline is not always the most efficient solution. In some cases, whole life insurance can still play a role. For example, it can be useful for estate planning, tax strategies, or providing guaranteed benefits to heirs. High net worth individuals may use it as part of a broader financial strategy, but for the average person focused on building wealth, it is often not the most efficient primary tool. Another important angle is financial clarity. When you separate insurance and investing, your strategy becomes much easier to understand and manage. You know exactly what each dollar is doing, whether it's protecting your family or growing your wealth. This clarity can lead to better decision-making and fewer costly mistakes over time. It's also worth emphasizing the importance of adaptability. Life is unpredictable. Your income, goals, and responsibilities will likely change over time. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.